What's up, my fellow wealth creators? Matty Ice here. In this video, we are going to continue the conversation about why I believe, anyways, dividend paying whole life insurance set up for high cash value is so freaking awesome. Specifically, though, why it is a much better bond. It's a fantastic bond alternative. And in fact, I would argue that it is far superior to bonds for the simple fact that it can get bond-like returns with so many more benefits that bonds do not provide. Right? And if we're going to allocate a portion of our capital in our portfolio to bonds, then why not, for the safety, right? It's supposed to balance our portfolio. Then why not explore the best, most efficient, safe assets available, right? Dividend paying life insurance is definitely one of those. Now, here's the thing. I'm not talking about whole life insurance that you hear discussed from the likes of Dave Ramsey, Susie Orman, other financial entertainers, right? Where they say that it's just a horrible place to put your money, terrible investment, even though it's not an investment. I'm not really sure why they compare the returns of a whole life policy to that of a mutual fund or stock market investments. It really doesn't make any sense to me. Would you compare your stock market returns to your bond returns? No. You wouldn't. That's why they consider it a diversified portfolio of stocks and bonds, because they balance each other out. Bonds are supposed to be safer, right? The safer fixed income asset. And then your mutual funds, whatever, in the stock market, it's more risky, but you get higher returns over the long run, whatever, right? But you don't compare those two returns. That's just kind of stupid. Well, I don't know why they then compare it to whole life insurance, because whole life is very comparable to bonds, CDs, high yield savings accounts, treasury bills, things like that. In fact, again, I think it's far superior than those traditional financial vehicles. And here's why: is because you can custom design a whole life policy for high cash value to make it much more efficient, to where it earns 3.5%, 4%, upwards of 5% net tax-free compound growth for the life of the policy. I don't know about you, but that sounds pretty good for a safe asset. I'm not comparing it to the stock market. And in fact, it doesn't even interfere with our stock market investments, because what we're talking about, or what I'm talking about here, is what I've done is reallocate a large portion of my bonds, the bond portion of my portfolio, into dividend paying whole life insurance. I don't actually even own bonds anymore. Not saying this is not specific financial advice. I'm not saying not to own bonds, right? But I moved a large portion of my bond investments over into dividend paying life insurance once I understood how it actually worked. Once I understood I could actually custom design it to where it gets bond-like returns with all of these additional benefits that I don't get from my bonds, right? It's just common sense. But because we're talking about reallocating some of the bond portion of our portfolio, it has nothing to do with stocks. With our stock investments, because like the argument that a lot of these financial entertainers will make and promote actually is the buy term and invest a different strategy, where you are supposed to buy your death benefit with term insurance because it's a lot cheaper than whole life insurance. And if you're only talking about the death benefit, that is true. But that's like saying I could make the argument that people should never buy a house with that same argument. Because if you can rent the same square footage and the same number of bedrooms, why on earth would you buy the house? Because when it's so much more expensive to do so over the long run, you have the down payment, you have the maintenance, property taxes, insurance, all this other stuff, right? It's way more expensive to buy a house than it is to rent, but people buy a house all the time. Why? Because you get so many more benefits buying the house than you do renting the house. It's the same thing with whole life insurance, guys. It's not just about the death benefit. When we custom design these things, we get so many more additional benefits that now we can start to compare it to things like bonds, treasury bills, CDs, and savings accounts, right? And we just get so many more benefits over those traditional vehicles, right? And then we can still make our stock market investments if we want. I'm not a fan of the stock market. I prefer Bitcoin. That's a different conversation, though. Nothing wrong with the stock market, all right? But my goal with this is to just shed some light, I guess, on the fact that maybe we should be a little bit more strategic with our money, with where we're placing our money, looking for better, more efficient ways or vehicles to put our money into, and not just follow the standard procedure of buy term and invest the difference, max out the 401k, invest in mutual funds, and maybe you'll be rich by the time you're 65, 70 years old. Who knows? Cross your fingers, right? I don't believe in that. I think we need to be more intentional. with our money, do a little bit of research. We don't need to be experts in this stuff. All right. But here's the thing, guys. When I started to go down this rabbit hole and learn about dividend paying life insurance, I was like, man, this is like the exact opposite of what I've been told about whole life insurance for my entire life. Like, this is so much better. Once I learned that you can custom design them. So yeah, anyways, let's get into some specific reasons why I believe whole life insurance is a far superior bond. So first off, what does life insurance have to do with bonds? All right, well, it actually has a lot to do with bonds because when we purchase our policy from a mutually owned life insurance company, that's very important, all right, because not all whole life insurance is created equal, right? Dave Ramsey, Susie Orman like to talk about traditional style whole life policies that are not set up for high cash value. You don't get access to any of your cash value like for multiple years, takes forever to break even, right? We're not talking about that. Right, so they're not all created equal. They're only telling part of the story that they want you to hear to promote their own narrative. Okay, there's another side of whole life insurance where you can buy them from specific types of companies where you are actually you're technically a part owner in that company when you purchase the policy. All right, so when we buy it from a mutually owned life insurance company, a lot of the premium that we pay gets put into what's called a general fund. This is the investment portfolio of the life insurance company, and it's typically very, very conservative. They're not making huge speculations in the stock market and all that stuff, and it's because they're on the hook for these life insurance death benefit claims, right? They have to make sure they're able to make those claims, meet their obligations, and pay those claims out every single year whenever they come up, right? So the general fund is made up of very, very conservative investments. The majority of them being, drum roll please, bonds. Okay, so in essence, what we're doing when we buy these policies is we're getting access to this massive, professionally managed bond portfolio. So instead of having to invest in bonds ourselves, we have this massive, like wildly successful life insurance company that has never missed dividend payments for like 150 years through the Great Depression, both world wars, Great Recession, pandemic, all that stuff. They pay dividends always, right? So we're getting access to their bond portfolio. I'm just going to say this, guys. They're much better at managing this stuff than we are. Okay, now you can buy bonds yourself, I guess, but we're going to get into why I don't see the benefit of that. Like again, not that we shouldn't buy bonds. Okay, what I'm saying is we get so many more. If we can get so many more benefits for those same dollars, why would we not take advantage of that, right? And if we're getting access to a massive bond portfolio, anyways, which the returns of that fund are given to us, they're passed down to us as the policyholders through dividends. Now, dividends are technically a return of premium, but it's much more than that. Okay, they're not just giving us our money back. If that were the case, our policy would never grow. Okay, so we have our guaranteed growth rate. So these policies are guaranteed to grow. All right, is your bond portfolio guaranteed to grow every single year? I suppose you're guaranteed that interest. Okay, but the value of your bond can plummet, like we've seen over the last couple of years. So bonds can actually be more volatile than we originally thought. That's not the case with whole life insurance. We're essentially getting access to this massive bond portfolio without the risk. We get guaranteed growth plus dividends, which are not guaranteed, but again, these companies have never missed a dividend payment for over 100 years. And the returns of of that bond portfolio is being passed back to us. Technically, it's tax deferred. We're going to get into the tax advantages here in a second, but that's reason number one why whole life insurance is far superior to bonds, in my opinion, is because we're getting access to a massive bond portfolio without the risk. We have guaranteed growth. We have dividends that come back to us, so we get to participate in the performance of that bond portfolio without the risk, plus all the other advantages that we're going to get into. All right, so that's reason number one. All right, reason number two is that when these policies are designed for high cash value, set up much more efficiently, and just a quick overview of that. I've done lots of other videos on policy design, but essentially when we're custom designing these policies, we are lowering the base premium and increasing paid up additions. So there's two primary places that you can direct your money to in these policies and custom design them. Lower the base premium, the lower the commission for the agent too. So all these people that talk about, oh, you're just trying to get a commission for the life insurance company, whatever. Commissions are drastically reduced when we custom design policies and set them up correctly. So don't even go there. The financial advisors in Wall Street make so much more on their management fees and stuff than I would ever make setting up a life insurance policy. Okay. Anyways, when we custom design them, All right, lowering the base premium, increasing paid up additions, makes it much more efficient. We get access to our cash value very early, up to 90% within the first 30 days. All right, we'll get into liquidity here in a second. But these policies will typically net 3.5%, 4%, maybe 5% tax-free compound growth for the life of the policy. All right, and again, going back to access to that bond portfolio, we have the guaranteed growth part of it. We don't have to worry about the value of our bonds, going up and down. God forbid that happens when you're in retirement, you're trying to sell bonds. It's not good. All right, but we get bond-like returns with all of these other benefits. So reason number 2 is that we can get very similar returns with all of these additional benefits. All right, and it's very comparable. And actually, you know what? I'm going to share my screen here really quick. Let me pull up the Moody's bond index here. All right, just so you can see again the comparison here and how correlated these two things are: dividend paying whole life insurance, the return that is, and a typical bond index. Okay, so as of right now, this is 5 days ago at the time of this recording, April 17th. Moody's seasoned AAA corporate bond yield 5.51%. Pretty good. I mean, interest rates are elevated right now, so that's good. Okay, but when I look up dividend rate history for Mass Mutual, which is like one of the biggest mutually owned life insurance companies out there, I think it's one of the oldest too. They have been paying dividends, have never missed a dividend payment since 1869, guys. That is crazy. It just goes to show the strength and stability of these companies, financially speaking, and how they're just the best risk management companies in the world. They're just awesome at this. In 2025, though, the dividend rate was actually increased to 6.4%. So over the last few decades, dividend rates have obviously come down quite a bit for life insurance, and that's because interest rates have come down quite a bit. So these dividend rates, they tend to follow and trail interest rates. All right, so that's why they've come down, but recently they kind of hit rock bottom. My actual dividend rate has been increased twice since I purchased it. From Lafayette, I started at 5.2%. It's now at 5.75%. So I'll take it. That leads to outperformance in the policy. But the other thing I want to say about this dividend rate, though, really quick, is that this is a gross rate. All right, it does not mean that your policy is going to grow by 6.4%. I want to be very clear about that. Right, this is before the expenses and costs and all that stuff of the life insurance company. All right, so don't make a decision on a whole life policy just based off of the dividend rates. All right, you don't want to do that. All right, what I'm trying to show you here, though, is the correlation, how they're very close. The yield on bonds and dividend rates, okay? 10-year average of 6.99%, whatever. All right, so you can see how closely correlated they are. All right, and if we go to Mass Mutual's dividend history here, here's this top line, this red one here, is or the green one, whatever. It's kind of hard to see. Anyways, this is Mass Mutual's dividend history, dividend rate history. Anyways, here is the corporate bond index, right? It's outperformed Treasury bills and all that stuff, right? And here's the thing: doesn't even take into consideration the next benefit that we're going to talk about. Reason number 3 is, what do I have on my list here? It was taxes. That's right. I was drawing a blank there for a second. Massive tax advantages with dividend paying whole life insurance, guys. Like bonds don't even come close to this. Interest. How is the interest on your bonds taxed? It's taxed every year, is it not? It's added to your income tax, I believe. Okay. Well, that's not the case with dividend paying whole life insurance. All right. As our policy grows, it actually grows tax deferred, technically, according to the IRS. But we can access our cash value completely tax-free in a number of different ways. We'll get to that in a second. But this is massive, guys. Here's one of the reasons why is, well, actually, I might be jumping ahead a little bit here, but I think it ties into it really good, is that with these tax advantages, dividend paying whole life insurance can just absolutely leave bonds in the dust long term. Now, here's the thing. In the beginning, we're actually pretty far behind a regular bond portfolio. Like if we were to take $10,000, put it into a bond portfolio, and then take $10,000, put it into a custom designed high cash value policy, the policy is going to be behind for a long time, maybe 10, 12 years, depending on how you set it up, company that you set it up with as well. And here's why. It's because you're buying life insurance. If you buy bonds, there might be a little bit of fees that you pay, whatever. All right, but typically the majority of the money you put into it is earning whatever that bond is paying. Okay, now you're going to pay taxes on that, which that has a massive drag on the long-term performance, and it's one of the reasons why dividend-paying life insurance will just significantly outperform bonds over the long run, 20, 30, 40 years. One of the reasons is because of the tax advantages. It's not taxed along the way. It's getting uninterrupted tax-free compound growth. All right, but within the first 10 years, you have to be okay being a little bit behind, which I don't see why that would be a problem because we're making long-term decisions here. If I'm behind a little bit in the beginning, but I'm way ahead over the long run, which is why I made the investment anyways, why would I not do that? Like, we're playing the long game here, guys. At least I am anyways. So tax advantages, we're going to be behind for the first 10 years. It typically takes 4 to 6 years, maybe 7, depending on age and stuff like that and how you design it, to get to break even, meaning how much premium you put into the policy matches what your cash value is. All right. But after that, guys, once that compound curve really starts to tick up, man, it just leaves bonds in the dust. It's not even close. All right. So you have to be okay with that. I don't have an issue with it because, again, I'm playing the long run. Now, reason number 4, this might be one of the biggest advantages of dividend paying whole life insurance over bonds is liquidity. Think about this, guys. When you need liquidity from your bond portfolio, what do you typically have to do? You have to sell your bonds. Okay. Well, now you're selling your assets and you're creating a taxable event as well. We don't really want to do that if we don't have to, right? I want that asset to continue to work for me for my like as long as possible. I don't want to sell the asset if I don't have to. Okay. Well, with dividend paying whole life insurance, that is not the case at all. Imagine if you could access the value of your bond portfolio without interrupting the growth, without having to sell the asset, right? But you could still access the value of it for an emergency or another investment opportunity, whatever. Maybe you want to put that into a piece of real estate or something like that. Well, that's exactly how dividend paying whole life insurance works. How? It's because when we need liquidity, when we need access to the value of our whole life policy, which is the cash value, it's like the equity in our policy, we can borrow against it. Okay. What that means is that we're using the life insurance company's money, not our own. So we still have this asset that's going to continue to get uninterrupted tax-free compound growth as if we never touched the money in the first place because we didn't. We borrowed against it. We used the life insurance company's money to cover the emergency, take care of the emergency, invest in real estate. I like private money lending. That's my thing right now, right? So I borrow against my policy all the time to lend on a piece of real estate. So now I'm earning in my policy, plus I'm earning on my investment. The only in real estate, the only cost of doing that is the little bit of interest that I pay on the policy loan. It's a loan, so we pay a little bit of interest. But here's something a little cheeky, right? Is because you're a part owner in the company, and you're contributing to the profitability of the company by taking that policy loan, that interest gets paid to the life insurance company. But if you're an owner in that company and you get that dividends, that's just coming back to you. Not all of it, okay? It's not like you're going to get all of your interest back. I'm not saying that. All right, but that's just like another side benefit, right? But the biggest advantage, though, is that we have liquidity, okay? We can access the value of our asset without selling the asset, without triggering a taxable event. And that asset is going to continue to grow for us while we use the money. And then we just slowly pay that policy loan back over time. A huge advantage of dividend paying life insurance over bonds, guys, in my opinion anyways. Reason number 5 comes with a massive income tax-free death benefit paid out to our loved ones. Bonds do not. So if I were to put, let's use the example that I was going through earlier. If I take $10,000, put it into a bond index, and I take $10,000 and I put it into a whole life policy, and then 1 year later I pass away, what's going to happen to those two assets? Okay. Well, the bonds, we could typically set up a beneficiary, so let's pass on the beneficiary. Maybe they sell it, create a taxable event there, whatever, right? But they're going to get the value of whatever the bond is at that time. Okay, and that'll be transferred over. Let's say it's $1,100. Maybe I make 10% that year, whatever. Or 11,000. Okay. With the whole life insurance policy, my $10,000 is going to blossom into hundreds of thousands of dollars, income tax free to my beneficiary. Another huge advantage of whole life insurance over bonds long term, because if we're gonna get bond like returns over the long run, right? Once our policy catches up, after it's got to break even and that compound curve starting to take off. All right, we're going to get bond-like returns, tax-free, and if something happens to me along the way, this is basically a self-completing plan where it would take my bond portfolio 30, 40, 50 years to reach my death benefit amount, right? But if I passed away, whatever the value of my life insurance policy is, it blossoms into this massive income tax-free death benefit, way larger than what I've put into the policy itself. Bonds don't do that, right? So this is really powerful financial protection for our loved ones as well, right? Bonds don't do that. You can pass the bond portfolio on to your loved ones, but it's not going to blossom into this. It's not going to blossom into a lot more money than it already is, and it doesn't get passed on tax efficiently. Okay. Now, there's one other thing I want to discuss with regards to the cash value and death benefit. That there's this really stupid argument that's made that I've heard many times. This claim that the life insurance company is just evil because they steal your cash value. And the argument would be, well, at least with the bonds, they don't steal your bond value, right? Well, life insurance company doesn't steal your cash value. I don't know where that came from. It doesn't make sense at all. So I want to debunk that really quick because I know it comes up when I start talking about like the death benefit and stuff. Here's the thing. First off, life insurance company just keeps it really simple. All right. They see the amount of death benefit that they owe. They write a check to the beneficiary. Done. Income tax free. It's done. Okay. But here's how I like to explain it to debunk this really stupid myth, this stupid statement is, let's say I have $500,000 of cash value in my policy and I have $1 million death benefit and I pass away. What's going to happen is the life insurance company is going to look at that cash value and say, okay, he has $500,000 of cash value. We're going to give that to the beneficiaries, but we're actually on the hook for $1 million of death benefit. So we're going to add an additional $500,000 on top of whatever his cash value is to meet our obligation of the $1 million death benefit. So do they steal our cash value or do our beneficiaries actually get it? It's just the life insurance company just doesn't look at it like that. They just write a check for the death benefit. That's it. Right. But like these financial entertainers will make the claim that the life insurance company, you get the death benefit, but you don't get your cash value. They steal that. Well, that's not true. You get the cash value plus more to equal the death benefit. Here's another example that I used to debunk that. If you had a $300,000 house with $150,000 of equity and you sold it tomorrow, would you expect to get both your equity and what you sold the property for, totaling $450,000, or would you just pocket the $150,000? All right, you pocket the $150,000 because you had $150,000 mortgage. You sold it for $300,000. You pocket the $150,000. You don't take $450,000. If you ask for $450,000, the bank would think you're crazy. Like, what are you talking about? Yet, it's okay to say that about whole life insurance. I don't know why. It doesn't make any sense. But the company's not stealing our cash value, guys. This is really, really good financial protection for our loved ones. I guess like a bonus reason number 6 really quick. I'm not going to get in. We don't really have to get into too much detail about this because there's not really too much to say about it. But creditor protection. All right. A lot of the times your bond portfolio, you got to have, if you have the right trust structure or corporate structure in place, you can protect it from creditors. But generally speaking, most people don't have that stuff set up. So if you find yourself in a lawsuit and you get a judgment against you, your investments could be at risk of being taken from you, right? With whole life insurance, there's usually in most states really, really good creditor protection. So even if you did have a judgment against you, 9 times out of 10, the creditors cannot come after your whole life insurance policies. All right. So now check with an attorney in your area because every state's a little bit different. But for the most part, it's really, really good creditor protection. So there's a little bit more peace of mind there as well. So anyways, this video is long enough. I'm going to go ahead and wrap up with that, guys. Those are the 6 main reasons why I believe whole life insurance is far superior than bonds, and at least worth a conversation, at least worth doing the research to see if maybe the money that I'm putting into my bond portfolio here might actually serve me better over here instead if I'm going to get so many more benefits long term. Again, it's not financial advice. Don't go liquidate your bond portfolio. He told me to do it. No, I'm not. I'm telling you to do your own research. That's why I do these videos. And I'm sharing the research that I have done, the conclusions that I have come to based off of my own research. I want to encourage others to do the same because these policies can be really, really powerful, provide a very strong financial foundation, solve a lot of different problems in our lives, provide a a variety of different benefits that we don't get from traditional financial vehicles. And I think that's worth exploring. So, anyways, I would love to hear what you guys think, what your thoughts are. Drop them down in the comment section below. And yeah, I hope you are crushing it. I will talk to you in the next one. I appreciate you watching, and we'll see you soon. Matty Ice is out.